Here, the elementary trading algorithms obtained from the derivatives of the base indicator are described. The derivatives of the base indicator are slope, angle, momentum, rate of change. Remember that the derivative is calculated not on the base indicator itself, but on its moving average. Besides, the rate of change is applied only to overlays, not indicators. Descriptions are the same for all four derivatives, and for each derivative the following algorithms are implemented. Derivative greater than threshold. For instance, slope of moving average of base indicator greater than threshold. This algorithm checks whether the derivative of the moving average of the base indicator is greater than the threshold, that is, a particular value input by the user. So the algorithm is true if and only if the derivative of the moving average of the base indicator is greater than threshold. Derivative positive. For instance, angle of moving average of base indicator positive. This algorithm checks whether the derivative of the moving average of the base indicator is positive, so the algorithm is true if and only if the derivative of the moving average of the base indicator is greater than 0. Derivative less than threshold. For instance, momentum of moving average of base indicator less than threshold. This algorithm checks whether the derivative of the moving average of the base indicator is less than a threshold, that is, a particular value input by the user. So the algorithm is true if and only if the derivative of the moving average of the base indicator is less than a threshold. Derivative negative. For instance, rate of change of moving average of base indicator negative. This algorithm checks whether the derivative of the moving average of the base indicator is negative, so the algorithm is true if and only if the derivative of the moving average of the base indicator is less than 0. Derivative between thresholds. For instance, slope of moving average of base indicator between thresholds. This algorithm checks whether the derivative of the moving average of the base indicator is between two thresholds, that is, two particular values input by the user. So the algorithm is true if and only if the derivative of the moving average of the base indicator is simultaneously greater than a lower threshold and less than the upper threshold. By definition, if the price is increasing, an uptrend is underway. If you want to locate a market uptrend, you can look at the derivative of an indicator following the price level. Basically, any overlay does that. For instance, you could consider the Kellner channels. As all the channels, its algorithms are split into two parts, one for the upper line and the other for the lower line. Let's pick up the lower line. You can say that when the derivative of the lower line is positive, the price is increasing and hence the market is in an uptrend phase. Select the slope of MA of Kellner channel lower line positive and put it in one of the slots of the long tab. By appropriately choosing the look-back periods, you can decide if you are looking at a short, medium or long-term uptrend. You can act on the look-back of the derivative, of the MA or of the Kellner channels. The algorithm is positive where there is an uptrend. If you want to detect a surge in the market, you can watch for high values of the derivative of a price-following indicator like an overlay. In this case, you can use the derivative greater than threshold algorithms. Arguably, the best derivative for this purpose is the rate of change, because its values are a percentage version of the difference of input values. So let's select the rate of change of moving average of Kellner channel lower line greater than threshold, and trim its input parameters. When the algorithm is true, there's a surge in prices. You can consider it both as a signal of strength of the market or as an overbought signal. In the first case, you might want to keep a long position open. In the second, you might want to close it. If you take the opposite algorithm of the preceding example, rate of change of moving average of Kellner channel lower line less than threshold, with same input parameters, you get the inverted algorithm. This time, when the algorithm is true, there is no surge in the market. When it is false, there is a surge. That means that when it passes from false to true, it signals that the surge in progress is over. If you activate the step checkbox, that's exactly what would be evidence, that is when the algorithm transitions from false to true. You could think of liquidating long positions when an upsurge is over, so you could put this algorithm in the Liquidate Long tab. When the derivative is near zero, it means the indicator it is applied to is basically constant. If the indicator is price following, then the price is constant, that is, the market is in a congestion phase. So if you take an overlay, you can say that when its derivative is almost zero, there is a congestion. For this purpose, you can use the derivative between thresholds algorithms. Let's take the Kellner channel lower line again. Select the angle of MA of Kellner channel lower line between thresholds, with appropriate input parameters. When the algorithm is true, there is a congestion. Maybe you don't want to trade during a congestion phase of the market, so you can put this algorithm in the Liquidate Long tab to liquidate long positions when in congestion. If in the previous example you select the Not checkbox of the algorithm, the logic is inverted and hence we can check whether the derivative is outside the range. So now we are checking when the market is not in a congestion phase. The algorithm is true when out of congestion. You can end this algorithm with a trend-following algorithm to make sure you apply the trend-following technique only out of congestion. For instance, in the Long tab. For some indicators, their value is not important, but their trend is. One of such indicators is the on-balance volume, or OBV. Through the derivatives, you can implement the recommendations found in literature. For the on-balance volume, it is thought that when it is increasing, then an uptrend is underway. In this case, you can select the momentum of moving average of on-balance volume positive to check when its derivative is positive. When the algorithm is true, there is an uptrend. You can put this algorithm in the Long tab. The second derivative is the derivative of the derivative. It expresses when the first derivative is increasing or decreasing. You can implement this concept by applying a derivative indicator to a derivative indicator as momentum of moving average of momentum. In this case, the momentum is the first derivative and the momentum of momentum is the second derivative. Or you can use a mix of indicators like angle of moving average of momentum. You might want to liquidate a long position soon enough, without waiting for declining price, but as soon as the price rising decelerates. For this, you can check when the second derivative becomes negative. It means that the first derivative is decreasing, although it might still have a positive value, meaning the price is still rising. Here, the momentum is the first derivative, and the momentum of momentum is the second derivative. And you can see that while the momentum is still positive, that is, the price is rising, at a certain point it becomes flat, and consequently the second derivative becomes zero, foreshadowing a probable stop in increasing prices. When the momentum starts declining, the second derivative is negative. It's as if the second derivative anticipates the first derivative. So you don't wait for the momentum to become negative to liquidate the long position. You act right away as soon as the second derivative becomes negative, and this happens much sooner. If you put in the Liquidate long tab the momentum of moving average of momentum negative, you can liquidate the long position basically at the peak of the price, maximizing the profit.